US dollar / the Japanese yen. Let's first read this disclaimer carefully, and then you do your good deed of the day by liking and subscribing. So we go here, US dollar / the Japanese yen. This is a very classic pair, 7% here from the low, 1.7-ish difference from the 52-week highs. So when we look here at the weekly data points, big giga picture, we have these monster time cycles, and we are now currently part of the declining phase of the monster cycle, but we also tend to have these small time cycles within, and they have been pretty darn good. Look at the price here and also look at the time cycle. Rise, decline, rise, decline, rise, decline, rise, decline, rise, decline, and we are currently part of that minor rising phase. I mean, this is pretty darn good. So there obviously there's something here with these time cycles and price. The seasonality, if we look here at the last 10 years as an example, 10 years, there tends to be a strengthening here from September into November. Over the last 20 years, yeah, from August, September, October, around October, there tends to be a peak in the strengthening of the US dollar, and then it weakens into December, January. So that is something that it does, to an extent fit here with the seasonality projection that we could, derive here from the time cycle. But we need to take into account that we could very well be part of this major declining phase. So the gravitational force of the major time cycles could be stronger, than the small time cycles. You could argue that we have something that looks like a very messy inverse head and shoulders pattern. The right shoulder has been so timid, so weak, that some technicians would argue that it's sort of broken to an extent, but it's still there. If we look here at the history of inverse head and shoulders pattern, like this one, it didn't work out. So there is that. Looking here at the daily data points, you could argue that we have an inverse head and shoulder there as well. But the history, the track record for inverse head and shoulders pattern, as we have seen, it doesn't have that very strong tendency of working out. So here we have these plethora of signals. The moving averages have converged significantly at this point, so we do not have extreme readings. But when the moving averages converge, then we do have a major battle zone. When we jump here to the daily data points, you could argue that the 100-day moving average in blue could form support-ish, but we see that when you look at the recent history where we did slice and dice that support level, that means that the current traders are not going to feel that confident about that moving average. So the probability of it working out here is far less than it was back here, because like here as an example, the 100-day moving average was a clear resistance level, then it became support, so it had legitimacy. And that is probably the reason why we did see a bounce here, but when it did get sliced and diced here, it makes perfect sense, like psychologically, that any bull here is going to be way more timid when it comes to their position size, notwithstanding that we do have that support level. So yeah, psychology, it really is a big deal when it comes to technical analysis. So we do not have extreme readings here on the RSI or the PPOs or the MACD, because we do have this just this convergence here of moving averages, because we have been stuck in this consolidation range. I think that from a purely technical perspective here, I think that when you take into account, especially the time cycles that we saw, you could make a strong case that the next big move could probably be to the downside. As you see here, I've also drawn in this horizontal trend line that, even though I'm not a huge fan of diagonal trend lines, but if you compare here the horizontal, dotted trend line here, which shows that yes, we do have some support levels. The diagonal trend line here, it might actually have more gravity, because there's quite a few points that it touches. This pink one. So yeah, I'm leaning a bit bearish here. If we look here at some correlations. So here is the correlation with the S&P 500 long term, minus 22%. Vis-a-vis the 10-year yield, it is positive 76%. Looking at the daily data points, then there's a positive 70-ish% relationship between this pair and the S&P 500. And there's a 33% positive relationship with the 10-year yield. I think that the signal that speaks the loudest in this case for this pair is definitively the time cycles. I think you saw yourself that they have been extremely reliable. So if I were to trade a signal, that would be my favorite.